For thousands of years, we have used banks to store our money. We share in the profits made by banks by allowing them to use our money to lend to others. The banks receive interest on these loans and in turn pass on some of it to us in the form of interest on our savings. Many people's life savings are held with banks, and if not life savings, then certainly short-term cash flow needs. When you think about it, we put an awful lot of trust into banks. We probably couldn't function without them. So just how safe is your money in banks? We saw just how bad things can get economically as the world's financial system teetered on the brink of collapse back in 2008. What if this happened again, but worse? In this video, we'll explore what banks are supposed to do to protect themselves from risk of collapse, the Bank of England stress tests, and what you can do to protect your wealth further. Hi, my name's Carl. I'm a regulated financial advisor and also work for a fund management company. If you're new here, welcome to the channel. In these videos, although I'm a regulated advisor, I am not providing advice here. These are not regulated videos, but purely guidance, are giving you things to think about, and then you need to go off and do your own research on. I'll usually cover lots of financial planning topics such as pensions, investments, ISAs, tax planning, and most importantly, preserving your wealth and legacy planning. I'll tend to cover a lot of topics that other financial advisors don't touch. So we could be talking about gold, property, or even cryptocurrency. So stay tuned for further videos. I'm sure you are probably aware of fractional reserve banking. When you deposit your cash in a bank, the bank doesn't keep it. They may keep some, but will lend or even invest the rest and try and earn a return on it. So if you were to go back to your bank the next day and ask for all your money back, they technically have to take it off someone else who has perhaps just deposited their cash. In fact, these days, it's all just numbers on a computer screen. You deposit money in a bank, the bank creates a number in your account. A borrower goes to the bank and gets approved for a loan, and the bank creates a deposit in the borrower's account. It is not taken from existing bank funds, but effectively created out of thin air. The borrower takes the money and receives an IOU from the bank, promised to pay the loan back with interest. The money created by the bank is removed from circulation once the borrower repays the loan. Now, during the great financial crisis of 2008, we saw how banks can collapse when enough people all want their money out of a bank at the same time. Banks just don't hold enough deposits to repay everyone. In the UK, banks like Northern Rock, Royal Bank of Scotland and HBOS had to be bailed out by the UK government or were taken over by other more stable banks. Even recently, we saw in Europe that Credit Suisse had to be taken over by UBS. Now, since the events of the great financial crisis, European banks have agreed to a liquidity coverage ratio. This rule forces banks to hold enough high-quality liquid assets to cover cash outflows for 30 days. Now, this in theory means a bank has 30 days to try and get itself together before then potentially having to be bailed out by the government or taken over by another bank. In 2023, the average liquidity coverage ratio across the 6 largest UK banks, which include Standard Chartered, HSBC, Lloyds, Santander, NatWest and Barclays, was 150%. So this looks like good news. However, the stress test used to come up with the liquidity ratio is based on a number of assumptions, including the type of economic conditions that would start a bank run, the amount of cash that might flow out of banks during the 30-day period, and what is deemed a high-quality asset. Now, quite frankly, it's all guesswork. No one truly knows what would happen if we faced another 2008 style scenario. Another thing that has changed in the UK since the great financial crisis is the development of the Financial Services Compensation Scheme. Now, the scheme is supposed to protect your cash deposits up to £85,000 per person per banking institution. So, if your bank failed, you should at least always get back £85,000. This is probably a reliable scheme if one small bank went bust, and the government are happy to commit to the Financial Services Compensation Scheme because in this scenario, a larger bank would probably come along and take it over. But if we have systemic bank failures, then I'm not so sure the Financial Services Compensation Scheme would be able to cover everyone's cash. According to the Financial Conduct Authority's Cash Savings Market Review of 2023, there is around 1.5 trillion held in savings accounts. There is no way any single bank or the UK government could cover even a small proportion of this unless the government decide to do some serious borrowing and money printing, which will rip the markets apart anyway and cause mass inflation. So ultimately, whilst banks are in a much better shape than they were in 2008 and can probably handle small-style economic crises, we just don't know how stable they would be to a risk we haven't foreseen. Now, cash is actually a pretty useless asset for building and protecting your wealth. The only reason to hold any cash is to cover your short-term spending plans. For the cash you do hold, clearly you need to ensure that you never hold more than £85,000 with one banking institution, just in case your particular bank goes bust. If you don't want the hassle of spreading your money around lots of different banks, then you could deposit it all with the National Savings and Investments, the NS&I. The NS&I are part of the government and guarantee 100% of your savings rather than just £85,000. Another option is to use short-term money market funds. You will find these on your broker platforms like Hargreaves Lansdown and AJ Bell, and can use these inside a stocks and shares ISA or even a pension. Short-term money market funds are effectively funds that invest in the loans of banks and other financial institutions, lending to each other on a very short basis, sometimes weeks or even days. The fund will receive interest on these investments, and it is usually at a higher rate than you will find with high street savings accounts. You should note though that this is still classed as an investment, and there is a small chance your money could go down. The best way to protect your wealth is to get it out of cash. Any cash you don't need for the short-term spending should be invested into real assets, something that exists and has not been made up like cash. Now, real assets include things like businesses. This could be private equity or public equity. Property and land could be residential or commercial. Gold and other potentially physical metals or commodities. And even collectibles. If the banking system fails, then you will still always have your real assets. Yes, in the event of economic disaster, it may take a while to value these assets, but they should be well protected from inflation, particularly if the asset is limited in supply. Now, no one knows what's around the corner. Protecting your wealth is as important as growing your wealth. So, get your money out of cash and into a diversified portfolio of real assets. You should then be pretty much as bulletproof financially as you can be. Now, I hope you found this video useful. If you have found some value, please give it a like, add a comment. If you've got any questions, please put them in the comments as well. I'll try and answer as many as I can. If you haven't already, please subscribe to the channel because that means you won't miss any future videos. And if you want further thoughts from myself, ideas and things for protecting and growing your wealth, then please check out my Money Matters Substack, and I'll put the link to it in a comment below. Till next time, take care.